So good morning, everybody, and thank you for joining us this morning. We are delighted to have you today as we discuss the significance of informal financial services for MSEs. And on behalf of CGAP, I'd like to welcome our panelists and all of our participants. First off, I'd like to introduce my colleague Fola, who will be moderating the session today with me. Fola and I work on the same team around MSc Finance Innovations. We explore what innovations enable the provision of financial services to MSEs and low-income groups at CGAP. And just to start us off, I'll just say a few words about the logistics and housekeeping. We'll request you all to keep your mics muted for the duration of the moderated discussion. And please post all questions on the chat. We have a dedicated time for questions and answers towards the end of the session. Then again, the panel discussion will be recorded and will be shared with both the panelists and participants. So thank you and welcome to our webinar this morning. In terms of the agenda, I'll make a few opening remarks and then frame our discussion. Then Fola, my colleague Fola, will introduce you to our panelists, and then we'll carry out the moderated discussion for around 30 minutes, and after which we will then answer your questions. We'll endeavor to answer all questions, and if not, we'll follow up on email. Then at around 10 a.m., we will close. So just to frame our conversation today, micro and small enterprises provide critical pathways to improved livelihoods for low-income households. And research has showed that MSEs with under 20 employees actually contribute to nearly half of job creation in developing countries. MSEs, however, face several interconnected binding constraints that normally inhibit their productivity, their profitability, their expansion, and among these constraints is the lack of access to finance. And in 2021, CGAP carried out a demand-driven market sizing study focused on MSEs in Kenya, Nigeria, India, and Peru that aimed to understand MSE finance needs across lending, payments, and savings. So we sought to understand, MSE finance needs across all the types of financial services. Market fit definitions were determined for MSEs in each country based on country-specific earning thresholds. And market definitions were determined for MSEs in each country based on country-specific earning thresholds and with regard to known global definitions. And so overall, as you can see from the chart, the research pointed to a consistently increasing demand for financial services among micro and small enterprises. And we saw that MSEs access these services from a variety of sources. Interestingly, the research showed that MSEs use informal financial services almost as much as formal financial services. And this was across all financial service types and across the 4 markets. And this points to the significance of informal finance and the role it plays in meeting MSE financial and at times non-financial needs. For this webinar, we'll focus on MSE credit. Another point I'd like to make is that we classified financial services into financial service sources into 3 main categories: formal sources, informal sources, and buy now, pay later, which is commonly known as BNPL, was neither classified as formal or informal, but was seen to be a significant source of MSE credit. And so Total MSE credit volume across the 4 markets in 2021 was about 250 billion US dollars. And in Kenya, formal services, as you can see from this graph, were high, as well as in Peru at 51% and 60% in Peru. They were the lowest, or rather they contributed the least credit to MSEs in Nigeria. In India, formal sources contributed to 45% of formal MSE credits in India. When we look at informal sources, it's sort of even across. The contribution to MSE credit from informal sources was sort of similar across the 4 markets. And then finally, buy now, pay later is an emerging form of credit and is used to cover monthly MSE costs and to obtain raw materials or stocks for business. It is a prominent source of MSE credit, particularly in Nigeria at 43%. We further broke this down to understand where does the formal credit come from. And the study categorized banks, fintechs, MFIs as major formal sources of credit. From this graph, the category other includes financial cooperatives, SACCOs, MNOs, and specialized lending companies. In Kenya, banks account for about 19% of the total credit supply. MFIs provide about 6% of the total credit supply, while fintechs, despite the boom in Kenya, provide 2% of credit to MSEs. In Nigeria, MFIs and financial cooperatives, now captured in the category other, are the largest formal lenders, each providing more than 8% of the total MSE credit volume in the country. In India, with about 80 billion US dollars in credit annually, banks account for by far the largest share of the total credit supply. Fintechs, again, despite their proliferation in India, provided only 1% of MSE credit. In Peru, MFIs are a more popular source of MSE credit at about 32% of the total credit supply. We also drilled down to understand the sources of informal credit to MSEs, and family and friends, local credit and savings associations, religious groups, money lenders were categorized as informal sources. And as you can see, there are varied preferences for different sources of informal credit among MSEs across the 4 countries. In Kenya, local savings and credit associations are the largest source of informal lending and provide approximately $1 billion US dollars of credit annually. MSEs are still heavily reliant on family and friends for credit, as this source accounts for 17% of MSE credit volume. In Nigeria, sort of the same case, with local savings and credit associations and other informal providers contributing to about 25% of the total volume of MSE credit. In India, family and friends are the largest informal lending sources and provide, as an estimate, 57 billion US dollars, which is 31% of the total MSE credit volume. While in Peru, family and friends also form the largest informal lending source and provides more than $3.5 billion of credit annually to MSEs. We then dissected the data further by differentiating between micro and small enterprises. And we found that micro enterprises rely more on informal financial services and informal sources generally as compared to small enterprises. Our taxonomy was more by the number of employees, where we had micro to be enterprises that have under 5 employees, while small had 6 to 20 employees. and average annual income for the two was defined for each market. And here we see micro enterprises rely most on informal credit. And finally, the research showed us that there is consistently increasing demand for financial services, and not just formal financial services, but also informal financial services. And in some markets such as Kenya, this demand is expected to double in the next 5 years. In Nigeria and Peru, the demand for informal credit is expected to remain steady with slight increases over time. The study also indicated that there is an overall expected growth of 29% across all markets, across all 4 markets over the next years. And now, with that as a summary of the study, I'll hand over to Fola to introduce our panelists.
Okay, thank you, Liz, and thanks everyone for joining once again. So I'll go briefly to the introduction of our panelists, and I'll start with Anzetse. Anzetse is a development economist with over 12 years experience in economic research, advising, and strategy in Africa. She currently works with FSD Kenya, and I'll just leave it to her to give a brief introduction of what she does. And yeah, Anzetse, please, over to you.
Thank you, and thank you so much for having me here today. So yeah, I work with FSD Kenya, the senior economist, and we work to improve the inclusiveness of finance systems and ensure that finance systems better interface with the real economy in a manner that is meaningful to low-income consumers, households, and firms. So that is very much, MSEs are very much centering what we do.
All right. Thank you, Anzetse. Let me move over to Diana. Diana Major is a senior specialist in financial inclusion and education at CGAP, which is the Development Bank of Latin America. She's worked at the Central Bank of Colombia and some other institutions. So over to you, Diana. Please give a brief introduction and background on yourself. Thank you.
Thank you, Fola, and thank you, Elizabeth, for the invitation to participate in this webinar. I work as a coordinator of the Financial Inclusion Program at CAF. CAF is the Development Bank of Latin America, and we support governments in the design and implementation of public policies or national strategies in financial inclusion and education, and also financial institutions in the design of financial products for MSMEs and individuals that close the financial inclusion gap. That includes commercial banks and also microfinance institutions and fintechs.
Thank you so much, Maria. Okay, moving on to Neeraj now. Neeraj is the co-founder and CEO of CredRight, based in India. So Neeraj, please give a background of yourself and brief information about CredRight.
Thanks for having me. Good morning, good afternoon, good evening, everybody. I am Neeraj. I am co-founder and CEO of CredRight. We lend to MSEs and we try and lend this digitally. What we are trying to do is people who are largely dependent on informal sources or have no sources of formal finance, we reach out to them. And based on their transaction history with Roscas, in India it is called chit funds, we try and build a better credit profile in absence of other financial data. And based on that, we try and lend to small businesses. We have already successfully lent close to $15 million based on that. And thanks again for having me here. Very excited to join this panel.
Thank you. We look forward to the further discussion with you. So, Tim, over to you. Tim Ogden is the Managing Director of Financial Access Initiative, which is a research initiative exploring how financial services can meet the needs and improve the lives of poor households, better and improve their livelihoods. Okay, Tim, over to you. Please introduce yourself.
Hello, everyone. As Fola said, I'm the Managing Director of the Financial Access Initiative, and Here today, because one of our major projects for the last several years has been something called the Small Firm Diaries. We use the term small firms to have a very specific definition of who we're studying, which is firms with 2 to 20 employees. And in the Small Firm Diaries, we've been following 100 to 150 of these small firms in Colombia, Nigeria, Kenya, Uganda, Ethiopia, Indonesia, and Fiji, each of those firms following them for a year. I should note that that is with the support of the MasterCard Center for Inclusive Growth, the Bill and Melinda Gates Foundation, the Argidius Foundation, the Aspen Network of Development Entrepreneurs, and not least FSD Kenya has been a funder and our partner in the work in Kenya.
Okay, thank you. Okay, I think we'll just move into the panel discussions right away. So I'm starting with you. Okay, so I'll start with Dana. Yeah, let's do the first. So one question for you, Dana. Why do you, and Neeraj can also step in. Why do you think we've seen that a lot of MSEs still, and even low-income people still prefer and continue to use informal financial services despite the growth and development of formal financial services available in the market, which all actually aim to address challenges faced by these MSEs, especially in terms of accessing financial services that serve their needs. But despite all the services available to them, all the formal financial services available to them, we see that many of these MSEs and low-income people still prefer and continue to use informal financial services. So what are your thoughts around this? Why do you think this is happening? Dana, over to you, then Neeraj can also chime in. Thank you.
Thank you, Fola. According to the evidence that CAF have in Latin America, mainly we collect evidence from the financial capability surveys in individuals and MSEs. We can see that MSEs still prefer to use informal financial services because they face important constraints to access formal financial services, as Elizabeth mentioned in the introduction. And what we can see is that informality represents an important barrier for financial inclusion. And MSEs operating in the informal economy find it particularly difficult to access and use formal financial services. And the evidence that we have shows that financial exclusion of MSEs and individuals is more widespread in countries where the size of the informal economy is greater. And achieving greater access to and use of digital payments is essential for advancing the financial inclusion agenda, especially among individuals and MSEs operating in the financial economy. And although we have seen an important growth in the fintech industry in Latin America, there is still a lot to do to develop the financial innovation ecosystem in Latin America and the Caribbean. And in this regard, what we found is that it is important to strengthen the development and growth of the fintech industry in the region that support the financial access of MSEs through some factors, which are first, the development of alternative credit scores. What we have seen in CAF through our financial inclusion lab is that there is a lot of evidence from fintechs in Latin America that are working in the development of these alternative credit scores that give more access to MSMEs to credit. Second, it is important to design financial products that are consumer-centric and consider MSEs needs such as the opportunity, speediness, shorter terms for payments, taking into account MSMEs income flows, etc. The third factor that we see as important is to develop factoring or e-factoring in order to use this as a collateral. And four, to work also in movable collaterals among other factors. In addition, what we can see is that it is important that MSEs owners also understand the benefits of the formal economy to have access to formal financial products and improve their level of financial education and business skills. What we can see is that levels of financial education and business skills of MSEs in Latin America is still very low compared to other regions in the world. In particular, based on the recent evidence from these surveys on MSMEs' financial capabilities in some countries in Latin America, what we see is that it is important to develop financial education programs that allow MSEs to learn to separate the finances of the household from those of the business. We see that still that there's a lot of struggle of the MSMEs in doing that, and also recognize the relationship between risk and profitability and the use of financial products suitable for them, and to know where to seek for financial advice. So it is important from the evidence that we have to work also in the design of financial education programs that can give MSMEs tools to a better financial decision making.
Following you on mute. So I will.
Neeraj, thank you. Please go over to you.
Thank you. Thanks, Joanna. We see multiple reasons. The first one is practical, which is, I have never been part of the formal credit system, so there is no bureau presence for me. And so I by default get excluded from the formal financing system, and I have to rely on the informal one. The second is more behavioral. I don't like going to swanky or big banks or other financial institutions because I believe I will not be treated very well over there. Historically, I'm not who is very well educated or who is exposed to the larger financial institutions. So I would rather rely on somebody who's looking like me and who talks like me. So that also, makes people rely on informal systems. The third is the convenience and flexibility around the informal system. To a friend or family, there's nothing called a fixed date of an EMI or a payment. So, a day delay or a 2-day delay actually doesn't matter in most of the cases. So that helps me. Fourth is the fear factor. I don't know what I am signing on to when a financial institute gives me a big agreement, which runs into pages, or even on a tech platform, terms and conditions, which I have to scroll forever to read and understand. And now I'm also not familiar with those terms. It is more like a jargon for me, right? So instead of signing on to something which I don't understand, I would rather believe more in the informal system, where I trust more from whom I'm taking money that they will not fleece me. Whether it happens or not is a different story. So we classify them into both behavioral as well as practical reasons of why people still want to access informal system when there are formal systems available. Thank you.
Thank you,
Thank
Neeraj.
you so much, Neeraj. Okay.
Yeah, thank you, Neeraj and Diana, for those very comprehensive responses and to pointing to the challenges that MSCs face that sort of draw them towards informal financial services. And so I'd like to hear from you, team, around, there certainly are informal finance features rules and procedures that make it more appealing to MSEs, as Niraj has said. Is there scope for formal providers to learn and adapt to some of these features?
So, I mean, I think there's always a lot to learn from the market. When we wonder about the state of financial services and what the needs are, we have to look at what's being consumed. The firm owners are making choices on a regular basis about how to finance their businesses, and they're making those choices based on the best available alternatives. And so, Diana mentioned the struggle that firms have separating household from firm finances, which I generally agree is true, but that's because the formal financial services providers, by and large, don't offer formal services to firms. They offer them to households. Now, that's not just true in developing markets. If you are a small business owner in the United States, the most common form of credit available is a credit card, and those are all personally guaranteed. They're not backed by the firm themselves, for good reasons from the formal financial services providers, because how do you assess the risk of a relatively small firm with very little records and very little history, very little documentation? So we always in these conversations have to say, yes, what is it that's being consumed, but understand also the constraints on formal financial services providers who have to have a business model that allows them to deliver these services in low information environments. I think what we see that formal financial services providers can learn from is the vast majority of credit for small firms. And here I am specifically, again, I think it's important to distinguish between micro firms, firms with no employees, and firms that do have non-family employees. I really think they're completely different universes of customers. But amongst the small firms that we've studied, a key feature is the need for flexibility. And that flexibility comes from a lot of volatility in demand and in access to supply. And so what those firms prefer in terms of financing is credit that allows them to vary how much and when they pay. And I do want to emphasize here too, though, that that's a very, very difficult thing for a formal financial services provider to replicate, because it really is relationally based, trust-based. So as a for instance, I would say that the vast majority of credit being extended to small firms is from suppliers who allow a small firm to take raw materials and pay for it later. There's no contract, there's no interest rate. It's a relationship basis between the supplier and the firm that allows them to pay when they can, when they have a buyer, and adjusts and is sort of dynamic. That's an expensive thing to do and requires long-term investment. And so, I think that the key point here is there's a lot to learn around the need for additional flexibility to account for the volatility that firms face, but also recognizing that that is a very, very difficult thing to replicate in formal finance.
Thanks, Tim. And Niraj, since you're in the same space and, we've had Tim talk about the trust-based relationships that tend to, make informal financial services quite attractive to MSEs. In your work in trying to, provide credit to MSEs that are currently registered in cheat funds, is there a way that the credit or the financial service you're providing to these MSEs sort of mimics some of the other harder, the other aspects of informal financial services, such that the service remains still quite appealing to the MSEs?
Sure, Liz. So, when we were looking at this problem and, when we first launched our app, it was in English. And, India is a place of multiple languages. We have officially more than 28 languages and hundreds of dialects. And we saw the struggle with the MSEs. So the first change which we did was to make sure that we bring those languages on the app. right? And and the vernacular language does really help the MSEs to access and build trust with the platform. Then later we realized that people do want to talk as well to to somebody who understands their language, who understands their pain point. And that's where we also introduced the concept of assisted model or feet on the street, where a person can help the MSEs. Then we also figured out in the journey that MSEs don't like to walk in to branches. They are much happier when people are talking to them informally or in their shop or in their premises. And that's when we started then doorstep service. I know everything adds to the cost of servicing the MSE, but at the same time, these are practical barriers. These are the this is how MSEs are attuned to take credit informally. So we try to mimic each and every step, even if added to the cost or to sometimes also friction in the process. But we realize that this still helps generate the trust. And at the same time, we see different behavior when the loan cycle comes to an end, or when the same MSE is topping up the loan. The behavior changes, because by the time you have built the trust, the same small business is more than willing to do or go on the process or on the journey by themselves, rather than on the assisted model. But to build that trust for the first time when you're interacting with a new customer or a new prospect, we really believe and see in practicality that unless you provide the similar service as you are taking a loan from a friend, it's very difficult for the MSEs to trust you, to believe you, and access the product.
Thank you, Neeraj. So I like the scope setting already. At least it's established already that trust is a very important aspect of it for the MSEs. And I see that team has also helped to lay background of the financial service providers themselves, with then also bringing in some financial capability and financial literacy angle. So thanks for helping to establish that. So let me speak with Anzet briefly. So should formal, based on all these backgrounds and from your own job and your experience, do you think formal and informal financial services should continue to coexist? And to what extent should that happen? And why is still there an underlying belief that informal services need to be replaced? Must they be replaced? Should they be replaced? Over to you, Anzetse. Thank you.
Thank you. Thank you for that question. I mean, I think one thing that's clear is that depending on the financial need that the MSE has, it will differ in terms of the qualities that it wants in terms of the credit, right? So it is not true that all credit is equal and all credit needs are equal. That is not the elements that we have. So if you look at the types of credit that MSEs have, they have three types of credit needs. They have credit needs to help them get through day to day. So you typically work with capital needs. There, if you have a fintech provider that's well reputable, trust is not really a factor. What they look for there is that they qualify and that it's quick and that the terms are reasonable. Cost is not really an issue, it's really speed. They need that quickly, and they need to be able to get that to meet their capital needs. So if you're talking about working capital, formal finance does interface that they're used, usefully. And that's why supply of credit is also useful there. The second type of credit need that MSEs have is shock needs. So if you have a shock, whether a stock gets lost or your store is broken into or a fire happens, and also you have to bear in mind that because MSEs are sold linked to household, personal shocks have a direct impact on them. So what we find is that when an MSE owner is trying to deal with shock, what they need there is patient capital that's flexible, that they can trust. So there, then family and friends become very important. So they can go there because they will not, this is not a cost that they had anticipated, but they need a line of credit that will allow them to deal with the shock, and then they can pay that back later. So what we find there is that MSEs are quite discerning, and then figuring out that, well, informal finance is typically what we're going to need here for a shock. Now, the other type of credit need that MSEs have is investing in the future. Whether it's building out, new stock or moving to new premises or expanding the qualities of their shop, however small it is, maybe building out a section of their house to do more storage. What we find there is that when they're trying to invest in the future, they need large amounts. And that's really, in our view, the least well-served need from both formal and informal sources for MSEs. That is why you'll find MSEs will tend to just straddle the micro and small space, and they'll have a very difficult time graduating into larger firms. The other thing you have to bear in mind is that not all MSEs grow in terms of scale, they grow in terms of diversification of firms. So there'll be one business owner with multiple MSEs rather than one MSE, this Western notion that you need to go small into big, no. In a lot of African markets, what firms will do is that they'll diversify into multiple MSEs, and that's how they're scaling. So depending on the need the MSE has, that then defines the type of credit features that they want. That then defines the appetite that they have for formal and informal. So I think it's really important to bear in mind that there's no one size fits all, because they're very discerning in terms of the qualities that they look at. The other thing you have to bear in mind is that depending on the state of the economy, the value chain that they're in, the sector that they're in, that will inform the level of sales that they'll have to actually access credit lines in the formal sector. So the point that Tim was making, there are just some sectors, the formal sectors, the financial sector is just not going to touch, agriculture being the most obvious. Yeah, they're just, no matter what you do, the formal financial sector is simply not interested in lending in agriculture in most African economies. So by default, those MSEs in that value chain will preponderate towards informal financial services. So I think you have to bear in mind that finance works in layers. There's a macroeconomic layer of what's going on in the entire country. So the public finance, FDI, the entire way the finance systems work there. There's a sectoral layer, which is what I'm alluding to here, where depending on the sector you're in, you may find formal finance is fine. So you may find that some MSCs or smaller firms in areas where formal financial service providers have appetite to lend to them, right? Retail trade or even tech, you may find that they have deeper exposure there. So there's that sectoral layer. Then of course you have the firm itself, where then things like collateral matter. So that's why the complexity of looking at formal versus formal doesn't work that way. What's more useful may be looking at what is the financial need that firms have, both household and firm, because they interface, and then the incentives and drivers that they're making to determine, okay, in this case, this is the product that I'm going to use. And actually what we found is that mobile money, fintechs are actually really useful for working capital needs. They're really good for that. But as I said, the biggest problem is on the expansion side.
Yeah, thank you so much. It basically starts from the needs and the kind of risk appetite the MSAs have. And one size does not fit all, the definitely have to create it. Okay, over to you, Tim. Please also have to answer that question. Let's have your view on that. Thank you.
I think, and by and large, I completely agree with Ansetse that starting from the premise that I think our language around formal and informal is a bit broken, in the same way that our language around what's a fintech service and what's a bank service is a bit broken, and our language around MSE is a bit broken, because we developed these terms at a time where we didn't have nearly the understanding of sort of the way things were developing as they do now. So when we talk about informal finance, historically, we talked about informal finance, it's been sort of a gloss on high cost money lenders or, concessional sort of group family sort of things. And I think what we see a lot happening with small firms is that there is more structured finance that's just not being offered by a registered or regulated bank. If we want to consider everything that's not offered by a regulated bank as informal, then I think the idea that we would replace all finance with formal is a bit insane. There's no reason to, then there's no way that could ever happen. If we want to move to a place where more firms have access to rules-based, reliable, trustworthy, non-predatory services, whether they're offered by a regulated bank or not, then yes, I think that is the mission that we have, is how do we figure out how to make sure that there is the varieties of credit, along the lines of what Ansetse was saying, available to the variety of firms that share these common features about availability, appropriateness, rules-based, trustworthy, non-predatory. And that can be in the form of supplier credit. It can be in the form of a written note between your wealthier uncle and you to gain the capital to buy the first machine to start your business. as long as these financing forms are available at a cost that makes sense and doesn't entrap people, doesn't deceive them, I don't think there's any reason why we would want to see things move more towards a regulated bank environment as much as a regulated, trustworthy environment with consumer protection. And so, I think it's also important to recognize in this formal and informal finance is that the firms themselves are providers of an enormous amount of credit. We referenced at the beginning the buy now, pay later, but there's lots of, I guess it would be pay now, buy later happening. So consumers are lending money to firms by making advance payments for something that they're going to get later. That's what I mean by pay now, buy later. But also the firms themselves are providing things to consumers that consumers pay for over time. So they're lending money to consumers and they're borrowing money for consumers, again, all within an informal label. And so the variety of ways that credit of all kinds is being extended is nearly infinite, and trying to capture all of that, I think, in a formal bucket is a fool's errand.
All right. Thank you so much, Tim. Thank you.
Yes, thanks, Nzetse and team, for really exploring, the differentiating factors between formal and informal, and the rationale behind MSEs accessing one or the other. I think those are very interesting perspectives. But then the next question is more around, the transition we've seen informal financial institutions at times go through. So for instance, over the years, we've seen various changes in informal financial service providers, and there have been various efforts made in formalizing and digitizing informal financial services. Can the digitization of informal finance, as we are seeing with Roscas in Kenya or cheat funds in India, help MSEs, and in what ways? I think, and this question is to you, Nzetse, and then Diana.
Thanks. I mean, I think if the aim is just to digitize, then that's not going to work. I mean, if there is a use case and a value case at the end of that digitization, then you're not going to have to make the argument. And that's what I often say, is that if you're having to try to convince people to do something, then you're doing the wrong thing. You need to look at what it is they want, what incentives they have to be behaving the way that they're behaving, to the point that Niraj was making, and then figure out something that can actually meet them at their point of need and take them further. So I think in the digitization of the informal, I think that happens to a certain extent already, in terms of the extent to which organized groups use things like mobile money and fintech, maybe not as a group, but there's an understanding of who holds the account, how that money is moved within the unit. So there's that sort of informal digitization that's already happening. But when we looked at digitizing value chains where MSCs are heavily present, like agriculture, one of the problems we had was, what are you going to use with my data? What do I get in return? What is all this visibility of my transactions, the history of my transactions, my businesses? Where does this all go? This is not the usual, oh, the tax man's going to get me, because you have to bear in mind, a lot of micro and small firms are already paying taxes. It's a misnomer, particularly in African economies, where there is fiscal decentralization. It is not true that MSCs don't pay tax. They pay tax often at subnational level. So when you're now talking about digitizing of a very important personal financial service that has created deep value over the years, the ultimate question you're going to ask is why, and what value addition is that going to bring? So I think until that question is answered, and I've seen a lot of this in the field where people just like, oh, digitization is good, let's digitize, oh, economies of scale. And they really miss the point of what is the value that MSCs are deriving from the current arrangement, and are you actually going to lead to attrition of value by forcing them onto platforms that are not even necessarily understanding what they want? They're not flexible. They're not. They're concentrating the capture of value. This is a big thing we're seeing, where MSCs are actually losing their independence through the digitization of financial services in some ways, because it doesn't allow them the flexibility that they had when they weren't on these platforms, or sometimes off them in. So I think it's really important to look at the why, and then you'll be able to find the use cases. And often you'll find that it depends on the credit needs. So in the case of working capital, those are already digitized. Certainly in countries like Kenya, that is already an avenue where deep digitization is happening. You don't need to make the case there. But in things like dealing with shocks and other things where you need more flexibility, you'll be asked why. And do digital providers really have the ability to provide the plethora of variables that MSCs are looking for?
Thank you, Anzet. Diana, you earlier spoke about that kind of transition and how we are seeing that fintechs in Latin America are, providing financial services to MSCs in a differentiated way. Perhaps you can also come in and comment on that.
Yes, and we also are seeing in Latin America experiences of formalization of informal financial services, such as Roscas, through microfinance institutions, which is very, very interesting as well. For example, in Peru, we can find some experiences with formal microfinance institutions, for example, as Financiera Confianza, that is reaching Roscas made up of women in urban and rural areas of the country. That is scaling up through digitization, because we can imagine that in Latin America, we are still facing some challenges related with connectivity, not also digital connectivity, but also the connectivity of reaching an office or a branch of microfinance institutions. So this digitization is helping microfinance institutions to reach several groups and several roscas in rural areas. And also these programs incorporate financial education with a gender approach, and help MSME owned by women to grow and also have access to larger credit amounts. So I think that all that we were talking about scalability is very important, and also to help these MSMEs owners, mainly women, to access a wider range of financial products and services, such as insurance. Also, we can find other experiences that are very interested. For example, COFIDE, which is the development bank in Peru, also organize and train roscas, which are called únicas. And then when they are trained and they are prepared, they can become clients of microfinance institutions. So we are seeing those examples where informal financial institutions can change in time. And in these examples, what we are seeing in the region is that Rosca's digitization has been key to expand their model to rural areas, to reduce the cost for the microfinance institutions, and also improve the efficiency of the Rosca management. And in addition, these are developed with financial education programs that we see that are fundamental to ensure that these MSMEs owners take better financial decisions. And also we can see also this gender approach, because in the region we are seeing a large gender gap in the access of credit by MSMEs owners.
Thanks, Joanna. Thank you so much. So I think I should just move on to the last question now, and I'll open this up to everybody on the panel. And please feel free to chime in. So what should the development community as a whole do to improve MSC outcomes? In terms of MSC outcomes, remain increasing the resilience, the stability, and growth opportunities for these SMEs? And should that be consideration for the informal financial services and these proposed actions? So please, I'm opening this up. Anybody can feel free to pick it up. Thank you.
I'll leap in first, coming back to some comments that Ansetse was making about the different types of capital that are necessary and the different rules or product requirements that are required for those to be useful for these kinds of firms. What we have seen in the small firm diaries research is the biggest gap, the biggest need for firms is working capital. And one of the questions we ask all of the firms is, what are your biggest barriers? And the most common answer is access to finance. And then we ask them about access to loans and desire for loans. And they tell us, the majority of them tell us they never need or want the loans that are actually available in the market to them from banks. And when we explore that further, the basic answer is they need access to capital faster in smaller amounts with flexible repayments. That's working capital. It's not investment capital. And the products that are available to them are larger amounts with fixed payments over a fixed amount of times that are very hard for them to predict. They're totally unsuitable to the actual need. And so I think top of the agenda for me is looking at how is it possible to expand access to flexible working capital credit. And I think one of the key possibilities there is for more traditional finance players to find ways to work with suppliers. I don't think in the short term we're in an environment where it's likely that banks will develop the relationships for the kinds of profit margins that are available on working capital loans when you don't know who your customers are. But the suppliers already know all of the customers. They know how trustworthy the customers are. They know how long they've been in business. They have the relationships. So is there a way that more formal providers can partner with suppliers to figure out ways to offer working capital credit that's flexible? The suppliers can't really do it at scale because they're not finance professionals. The finance professionals can't do it because they don't know who the customers are. If there's a way to find for those two to meet together, I think there's a lot of possibility.
Yeah. Okay. Thank you so much, Tim. Any other person?
I'll step in. I'll step in and
Yeah.
I'll just give the economic angle to this. I agree with everything Tim has said and pretty much everything everyone has said, the other panelists. I think macroeconomically, the reality is that if you have a government that's borrowing at 14, 15%, that is already crowding out MSEs. If you're looking at then the type of firms that will then be having to be running at a level where they can afford interest rates that are 20, 35%. So the biggest way to actually get deeper formal finance to small firms is by fiscal responsibility, where government brings down its borrowing rates in Africa, where we have governments borrowing at 1 to 2%, so that you have a private sector lending that can be happening at 4 to 5%. You will crowd in so many more MSCs just by bringing down those interest rates. So the first thing economically is more public finance. The other big thing is inflation. One of the things we're seeing in Africa now, which is like, I completely agree that informal finance is going to go up in Africa and everywhere else, because the way interest rates are being hiked to deal with inflation, again, you're just going to keep locking out the amount of MSCs that are running their businesses at a level where they can afford finance at 15, 20, 30%, right? So the big levers, if you're talking about interest rates and the way interest rates lock out private sector, and I'm not talking about volumes, I'm talking about interest rates, you've got to get fiscal responsibility so that government lending is bottoms out as low as possible. You've got to get macroeconomic monetary policy so that inflation is down and you don't need to have a base rate that's high. You can have a very low base rate. If you can bring those two down, then you will find that the appetite that micro and small firms have for formal credit will increase, because if you're now dealing with a loan that is 4 to 5%, that's a completely more manageable than dealing with the current environment of 20 to 25%.
Oh, interesting. Thank you so much. Any other person who wants to chime in?
So,
Okay,
so Neeraj here, Fula. We see this unique problem again here in India as well. banks right now in India, and it's the cycle. They were highly leveraged. There were a lot of bad debts. In last 4 years, it got cleaned up a lot. And right now in India, the problem is reversed. Banks are sitting on cash and they don't know whom to lend to. At the same time, there are a number of fintechs like us for whom the cost of capital itself is very high, which transmits, as ancestors were saying, to as higher interest rates to the MSEs. This is where the development institutions, government institutions can come in, provide more credit enhancements, on behalf of us to the banks, for us to get cheaper access to finance. That really helps, because in the formative years for any fintech, the access or the cost of capital itself is so high that it finally translates to a significantly higher rate, or to as close a rate as informal rate to the MSE. Bringing that down will really help.
Yeah. Thanks, Neeraj. All right. So, Jana, would you like to give a last thought on this, or we just move on?
Yes, very, yes, thank you, Paula. Yes, very quickly, we at CAF are working in three main areas. The first one is to support governments in the design and implementation of public policies that promote the development of MSEs and take into account their main challenges, as we have mentioned in this webinar, the lack of access to financing, the financial exclusion caused also by the lack of knowledge of the financing options available, the lack of business skills, the lack also of specific and sector relevant skills, and the lack of financial education, including knowledge and confidence to access various forms of financing. And regarding the lack of access to finance, public policies must contemplate the implementation of measures for the development and promotion of formal financial instruments adapted to the conditions and needs of the different segments of MSEs, emphasizing those with greater access gaps, such as women. So we are working very closely with governments in the region to develop those national strategies of public policies. And second, also support microfinance institutions in their digital transformation. We think that this is key to improve their offer of financial products and non-financial services. And lastly, to strengthen the financial innovation ecosystem to support the growth of fintechs in the region that are developing solutions to close the gap in the access to finance for MSMEs. We think that, and we see fintech industry as an opportunity to improve the access to finance for MSMEs.
Thank you. Okay, I think that brings us to the end of this discussion. Thanks for the high-level breakdown from inflation to what the government should do, to what all the other participants should do, including the development partners. So over to you, Liz.
Yes, I think we have just a few minutes left. I've been looking through the chat and trying to answer the questions, and I see Fola has been doing the same for our participants. I think just the one question that's there is around the constraint of collateral for MSEs when it comes to accessing financial services. And I can ask Tim to quickly comment on that in 30 seconds so that we can close.
The purpose of collateral is to overcome the information constraint, right? It is the way that formal finance providers who don't have very much information about borrowers to overcome that lack of information. And so I think when we think about collateral, you're never going to do away with some form of collateral. Because you do need a way of finding ways of enforcing repayment. Figuring out alternative forms of addressing that informational constraint along the lines of what Niraj was talking about that CredRight is doing, along the lines of mentioning is that the additional use of digitization, not just to deliver the services, but of ways of gathering some information, overcoming some information constraint, finding new partners, as I was mentioning with partnerships with suppliers to overcome that information constraint. I think that's our key way to deal with a lot of the collateral requirements. Here I would just also note that that framework, group lending, whether it's actual enforced group liability, is a form of collateral, right? There is no lending that is collateral-free lending. It's a relationship collateral, it's an information collateral, it's an asset collateral. So, starting in that thinking from how do we get reliable collateral, whether it's in the form of asset, whether it's in the form of information, whether it's in the form of relationship, that's how we can extend more credit.
Thank you. Thank you so much, Tim, for quickly responding to that and in an apt manner. So I'd like to close out the webinar by saying a big thank you to our panelists for showing up and for giving us very solid answers to all the questions that we had about informal financial services. We had a lot of big insights around digitizing, not for the sake of digitizing, understanding MSEs clearly so that we can figure out what financial service is more appropriate, informal or formal, and the coexistence of both. So thank you very much for all your comments and for your participation. Thank you to the participants for joining us. We will be sharing this recording to you, the participants, as well as the panelists. Also, you can look us up on the CGAP website at cgap.org. Thank you so much and have a nice day or evening, wherever you may be.
Thank you,
Thanks to the
everyone.
CGAP team.
Bye.
Thank you.
Bye-bye.
Bye.